Hi, Jing. Thanks a lot for coming to this 25th episode of Value Creation in Life Sciences. So, to start with, why don't we start with your introduction? Maybe you can introduce us to the audience.
Okay, so I'll be short. My background is I was trained as a biophysicist. I got my PhD at Johns Hopkins University. After that, I went to work for McKinsey in their pharma medical products practice. After 4 years, I left, and I left in 2010. And since 2010, I've been doing two things. One is that I still do consulting. I consult with life science clients, including biotech, pharma, other life science tools companies on strategy, due diligence, and other type of projects. And the other hat I wear is I'm a biotech entrepreneur. I started Attennua in 2000 and I think 16. That's when I got my assets. I acquired 3 phase 2 ready but shelved small molecules that failed their phase 2, and I repurposed one of them for cough, idiopathic chronic cough. It took me 2 years to raise $35 million in Series A from some really, really good VCs, led by Omega Funds, joined by OrbiMed, Abingworth, Red Mile. Unfortunately, they ran the phase 2A and it didn't work. It was actually a very clear failure, even though the animal model suggested that there was a good rationale for working. The company liquidated. They decided, well, we burned through around less than $15 million of the 35. Might as well just sell the assets and reallocate that money to something else. So that's my kind of first biotech startup. Then I was brought in to try to rescue a phase 3 ready asset, which it's not very sexy science. It's actually high bioavailability DHA for sickle cell disease. There was amazing data. Again, not perfect. It was short, but amazing data. You basically have patients that are on this treatment in an open label study where they have not experienced a VOC for 18 months. But unfortunately, the science was not sexy. The investors were let's just say dysfunctional. I was brought in as almost like the interim COO/CEO. I even had a deal lined up for them with another family office VC, but they thought the deal was too low. And they said they for whatever reason, they think, the company is worth a lot of money, and they decided to try to do it themselves. And that went nowhere. I think the asset got basically sold at cash or zero value, just taking on the cost of patents and liabilities. So it got nowhere. So that taught me a lesson of be very careful of even the science looks great. Be very careful who you work with in terms of the investors. So right now, I after that I relocated from New York to Europe. I actually moved to. I wanted to take a break from biotech. I was actually building a data cleaning as a service, kind of an AI machine learning assisted data cleaning service in Ukraine, where there's a lot of data scientists and programmers. Right. But then the war broke out. I went to Amsterdam. Originally, I was going to go to Amsterdam and split my time between Amsterdam and Kiev. But then COVID hit, and the Netherlands was closed for all Americans, so I couldn't go there. So that's why I went to Kiev. But now I'm in Amsterdam, but I'm also potentially looking to move to Barcelona for the great weather. So that's welcome. That's my introduction.
Super. Thanks a lot. So your Twitter post kind of was very interesting. I wanted to kind of discuss a couple of things regarding this biotech crash that has happened. So in the Twitter post, you argued that most of the companies who are trading below cash should liquidate. Okay. So my first question is related to the psychology of investing, meaning imagine the biotech market hadn't crashed, right? And we still had, because biotech market crashed and there were several reasons. One of the reasons, as I was reading, was a lot of negative readouts and so on, or regulatory things kind of getting up. Um, so if, let's say, the market hadn't crashed, would you still advocate that those companies whose lead asset might have failed, okay, would think about liquidating back?
Yeah, I think it's. I would still make the same argument, right? They basically, you know, this biotech crash just exacerbated all the problems. So, if the challenge is that as a public company, sorry, or as a private company, a lot of times, your really job is only as a biotech company CEO and management is to just execute on the program you set up.
Right.
Right. The valuation is really, your VCs are going to help you shepherd that along, right? Because they decide whether they want to invest more money. They help you set the valuation, But as a public company, it becomes a little bit more challenging because if you were to raise more money, right, your market cap almost like puts you cannot raise at a higher valuation than what your market cap is trading at.
Correct.
Right.
Yeah.
And oftentimes it's the 10% discount from what's been trading at. So a lot of these biotech companies, is trading, especially after a lead clinical asset failure, and have no backups, no backup clinical programs. They are trading at less than cash, right? They're trading at, a lot of times it's not uncommon, even before the crash, to see these companies trading at 50, 60% net cash because investors have lost confidence that there's anything worth of value in a company. And the reason why they're trading less than cash is because the companies are still burning through cash, right? It's not like once the clinical stage assets fail, they stop spending money. No, they still have a lot of employees. They're still trying to work on other preclinical programs. And the investors are basically saying, look, sure, I can value your company at cash, but I have to account for cash burn, so that's why they're trading at a fraction of the net cash that they are. So this crisis is different in the sense that, it's even more severe than that. A lot of times a company that's trading under cash, they may still have enough cash and they may still have enough programs where they, let's say, can push and finish let's say a phase 2A trial and show positive data and then be able to raise more money, right, in normal times. But what's happening now is that I think a lot of investors are skeptical that even in the 12 months, even if they have better data, that the capital market, at least the public capital market, is not available to them for additional fundraising. And because let's say if you show a positive phase 2 data, okay, then you got to run either phase 2B or phase 3. That requires a lot more money. So you actually have to raise a lot more money. And I'll just use an example. Let's say you have a public biotech company trading at $50 million market cap, and it's basic. They may have, call it, $80 million cash on their balance sheet. So let's say in 12 months, they have to run this clinical trial, and they're left with, let's say, $20 million. I'm just throwing some numbers around. But the problem is that they cannot raise any additional money at $50 million. I mean, that's so dilutive for existing investors. So if you actually own if you're a public investor and you own a share of this company, even in the best case scenario, you're going to get so diluted. There's no guarantee that you're going to actually make your money back, even in the best case scenario. So that's a challenge this market has, is that I think a lot of investors are skeptical that the capital market will return, let's say in a year or so. And I think there are probably, I think their skepticism has merit, because if you look at how much, at the end of the day, I think you have to realize, in the universe of stocks that investor buy, right? Biotech is the hardest for investors to understand, just because it requires technical expertise. It's much easier to understand, even tech companies are easier for them to understand than biotech companies, because there's no binary kind of risk that comes with the tech companies. Tech companies have crashed, even more, I would say, right? I mean, it's like some of these companies are 80-90% down from their peak. Mm-hmm. I think when the capital market comes back, you have to think that a lot of these investors that actually do have cash on the sidelines, they're not, the first thing they're going to rush into is not necessarily biotechs. The first thing they want to rush into is probably back into these tech companies. So I think, I personally think that, it would be very wishful thinking for biotech CEOs to think that they can just ride this out and money will be there, by next year this time. I think there's a very high risk that may not be the case.
Correct. So before I get into what are the other opportunities that this current situation might pose, would you also agree that the situation where we are in, it also could be, one of the reasons also could be investors funding low quality assets? Because when you have huge capital flows.
I disagree with that. I disagree with that. I think the asset quality is high, but they're early. So I wouldn't necessarily think that the science is low quality. It's that they're early. And not only they're early, when they IPO, the valuation was way too high. The expectations were way too high. So I think there's great quality science in a lot of these companies. It's just, there are not enough investors that understand these companies well enough to support their valuations. So that's not the reason. So I don't think poor quality science is the reason for the crash. It's that, if a typical, public investor, right? I mean, they buy this, they buy a biotech company. They expect that, okay, they get acquired someday by a big pharma company. That's not going to happen with a lot of these companies that are so early to be of any interest to big pharma. Right now, my friends in big pharma business development are telling me that they're not looking at any assets that don't have, really good phase 2 data. I mean, they're not even talking to companies. So it's not bad science. It's just too early.
Exactly. So my point was that, of course, I would, it's a better term is as a let's say lack of discipline in investing. Because when you have a lot of capital flows, you tend to invest in very early stage where the outcome is more risky, actually, right? And you give valuations which are not worth depending on that particular stage. So ideally, it is a lack of discipline on the part of the investors as well.
I think you can argue. I mean, there are reasons why investors do that, right? I mean, because for private companies, well, when the valuation is not. I mean, to be honest, cynically, I actually don't think the VCs truly believe that the valuations that they invest in private rounds are really, the companies invest in at those valuations are really worth that much. Cynically, I think that they can mark up their next investments, the valuations in their on their portfolio, and for a while the public market was buying those valuations, and they can actually exit those investments at those valuations. So they are doing their job. I mean, I think they're VCs that they're allocating capital and they're generating return of capital for their limited partners. So
exactly,
but
I think
I don't necessarily think it's a discipline in the sense that they pick bad science. I think there may be a little bit of too much of euphoria.
Exactly.
But
Exactly.
yeah,
I think that's the reason also for the market cycles as well to occur, right? Because during the boom times, you keep investing more in even assets and where you justify your investment, both in tech and biotech as well, right? So in tech, for example, if you keep investing during the boom times, you would argue that despite the negative cash flow, this is to scale up the company, for example. And once it goes down, then you justify saying that no, now the cash burn has to be controlled and so on. And that's the whole psychology of investing, of booms and bust, actually, right? So and I think this is a natural human phenomena, and today we are in the down cycle, and in a couple of years I think we will forget it, and we might again come back to the cycle where we again keep investing very early stage assets, right?
I I cannot predict what's going to happen. I can only give you my opinions of what I think companies should do in this area. I think I made another post where I feel a little bit lost as a biotech entrepreneur in terms of creating value, right? Because
Mm-hmm.
if you're an early stage biotech founder, you are doing things that you hope, let's say many years down the road, you will generate return on investment, both the money you invested, the sweat equity, and also, the anxiety and the stress that you've gone through. But I personally feel like it's highly unpredictable right now, and on a risk adjusted basis, because as a biotech entrepreneur, you're almost like taking a binary bet, every time you do this. And it's not on a risk adjusted basis, given that a lot of things fail. It's not the best approach. Now, there are a lot of lucky biotech entrepreneurs where, that one biotech that they start, they end up selling to a strategic early. And but if you look at the entire pool of, biotech entrepreneurs, founders, even with great science, great ideas, great execution, there's no guarantee that, they'll get paid for the kind of risk and reward that makes it favorable. I say it makes it sustainable.
Correct. Super. So I also liked one of your points that you made regarding how you can create a seed fund out of where you gave an example of so can you just talk us about that, just your ideas, just to kind of understand how you can best.
So my idea is basically boils down to this, right? You have so many companies, and I still need to do this analysis. I asked a friend to pull a list of negative enterprise value companies for me, biotech companies, just the US listed, and there was like over 400. So meaning these companies are trading below net cash that they have. Okay, so basically the market is telling them that we place zero value or even less than zero value, negative value on the actual, assets and programs that you have. And, you cannot raise money on assets. Like, okay, well, how do you value this? And you cannot raise money on something that people feel like it's worth nothing. Right, it's highly dilutive. Your existing shareholders are not going to get their returns. They're not going to get their money back, right? So my idea is like, well, if the public market is not valuing these assets at what they should be in normal valuations, and your existing shareholders are at the mercy of your cash burn, right? It's like, well, they don't want to get diluted. They'll never make back their money if biotech company keep doing this. You might as well, especially the companies that are trading way below cash, let's say 50% net cash, they might as well just return a big chunk of that money back to shareholders, and take the assets themselves private, right? So that's basically the whole gist of my proposal. And the mechanics of it, where a C fund makes sense, is that if you were to just do a single company liquidation, so let's say you have a company with $100 million cash, no lead clinical assets, but with some preclinical, let's say a platform. Maybe the platform is great, but the biology they pick for their lead clinical assets, it failed not because of the platform didn't work, but because the biology didn't work. So they got to go back and let's say pick another target, another disease, but it's way too early, right?
Yeah.
So let's say you have $100 million cash on the balance sheet. You have the market cap, let's say it's $50 million. So, and you're working on preclinical programs, and you have all this cost associated with a public company, right? All the C-level executives, and frankly, a lot of these C-level executives are needed when you IPO. You get better valuations when you present. You have a full team of very talented people. Otherwise, if you are an IPO and saying, "Oh, we have this is a virtual company with 2 people running," you're not going to get your high valuations on the IPO. So that's actually the reason why a lot of investors they actually pick a management team for the IPO, right? But when let's say the lead clinical program failed, and now they're back just on preclinical stage assets, it doesn't make sense to remain public to have that many people, right? So that's why. There's so many of these stories out there where you have very talented CEOs. They have good science, but they're just so far away from clinic, and the market values them at a fraction of their cash. So my proposal is that it's better for all shareholders, all stakeholders, whether the shareholders, the management team, because the management team at this point, their options are way underwater. And if they keep raising money at this low valuation, they'll never get back. They'll never make any money. They're basically just collecting a salary. So my proposal to the C fund is a more efficient way of actually taking the company private. Right. So the single company, if you actually have to go through a formal liquidation process. Okay, we're going to shut down. We're going to pay this much. Then we got to take care of all the liabilities. We got to keep some sort of alive. And let's say if trying to take a way too many public investors as private shareholders comes with its own cost, right? So the idea is like, look, you give let's say $100 million, you give $80 million cash back to shareholders. Right now it's trading at $50 million. If you give back $80 million, it's like, you're almost giving them a 60% bump on their share price, right? So it's actually a good approach. And then of the remaining $20 million, you basically are taking all your assets private and run it and until run it in a private company, so you don't have all the costs associated with a public company. You run it in a very virtual manner. And wait for the data, right? And then when you actually have good data, you don't have a public market cap that's setting your valuation on how much you can raise money, right? You can justify, an alternative valuation that's not limited by your market cap. And your existing shareholders, if they can still own the upside of this, right? They still benefit. It's not like they're just giving up their upside, right? Now, it's a lot more challenging, I think, from a single company liquidation to manage all the shareholders that still want to keep a piece of the upside. So the idea of a seed fund is that you can do this by basically merging with another company. So let's say you have a large, let's say you have $200 million, so 2 companies with $100 million cash. Okay, one of them, forget it. We're going to stop all preclinical programs. Just turn that $100 million as a seed fund. Okay. So the mechanism would be that you would merge these 2 companies together. Okay. But the $100 million, so you return, let's say $80 million to the company that is being acquired in the sense to return the cash. It's like, hey, we'll pay you $80 million cash. And then you let them basically spin out this private company, but the seed fund owns it, rather than having multiple investors owning kind of piece of a private company, individual investor in a piece of company. you can actually have the seed fund own the upside of this private company that got spun out, right? So then other public investors basically get share of the seed fund, and they share the upside, right? The idea I have is, this is, you create the right incentives for everyone, right? You give the management team to go back. If they really believe in the program they're working on, you give them a way to reset their compensation. You give the existing investors a bump in, you basically give them like a 50% bump in their share price in the public market by returning cash to them. And then they still retain some upside through the seed fund. So I think it's just never been done before, but it doesn't mean that it's not feasible, because there have been public venture funds, publicly listed venture funds. There are, and there have been plenty of mergers where, let's say one biotech company acquires another biotech company, they let the management spin out their preclinical assets back into a private company, and they may even invest in them. I mean, that has happened before. So what I propose on a technicality is not unprecedented. So, and I think if you maintain the upside for the existing investors, it should not be. I don't think they should have any ground to sue you for trying to like steal assets on the cheap. That's because you still own a good chunk of it. The market is valuing these assets at zero or less than zero, a negative value. So you can. There's no way for them to justify that these assets are being sold on the cheap.
Correct.
So that's my idea, and I think I was surprised that thread got actually a lot of traction with even hedge fund managers who think that that might be a way. So I really want to see this happen, because I think it's very doable. And if you look at Ligand Pharmaceuticals, how they pivot their strategy, they basically pivoted towards from drug development to just acquiring platform assets, do almost minimum amount of work to get them to let's say a phase 1, and then license out these programs and the technologies. So this model of investment is not unprecedented.
Exactly. That's what I think. These kind of situations also lead to several opportunities. In fact, if you see some of the non-biotech companies, even I was reading about Warren Buffett, where he has dealt into these kind of deals where the company was trading below cash earlier as well. So that also leads to several situations like management buyouts, or you could turn around the business, as you said, to using the model that you proposed, or it could also be an interesting takeover candidate, maybe, depending on the situations of the company by big pharmaceutical companies. And I think, the last point also was, I was looking to, we are short of time, but maybe quickly we can discuss about the reverse merger, because this also opens door for a reverse merger process. What do you think? Not for all companies, but yeah.
I think so. Here are my thoughts. A few points. The first point is, in this market, reverse mergers are not working. So typically what happens is this reverse merger, you basically have a cash shell and they find promising technologies to go develop. Okay. That's not what's happening in this market. This market, you have cash-rich shell with good science, good programs, and the market doesn't even value them. Okay. So you basically have a biotech company. So reverse merger typically bring in probably like early stage assets, right? And then you hopefully, you get a bump and ideally trade above cash, right? So let's say you have $100 million cash, you bring in some promising technology. Ideally, you want the market cap to be 200 million. So valuing the assets, at like 100 million, or even 150 million at a minimum. And a lot of times reverse mergers, after reverse merger, typically you actually need to raise even more money. Okay. That's why it's not going to work here. Number one is that if you look at the number of biotech companies that are trading below cash with meaningful kind of early stage programs, that means the market doesn't value like these programs. Period. So a reverse merger is not going to get any valuation bump in this market.
Yeah. So
And second,
I was not. Yeah. Sorry to interrupt. Actually, I was not thinking about reverse. I mean to say, reverse merger is a technical process, where a private company gets public, right? So think about a company where we talked about they have 100 million cash and they do not know how to use that fund because their lead asset might have failed or whatever it is, right? Let's say this is a situation, and you have an interesting private company, okay, uh, where they can reverse merger to get public and use that 100 million cash, and they might raise the money, for example, 1 year down the line, 2 years down the line, for example, and by that time the situation might be better because it's ideally, if the company doesn't have cash, the shell company doesn't have cash, then there is a problem because you become public and then you have to raise money, for your own. But if the company already has cash and you have another clinical stage company, for example, looking to go IPO, for example, they can use the reverse merger path to kind of become public, use that money that is already in that particular shell company and raise the money later point of time. Of course, at this point of time, if you raise, it's not good for anybody, as we discussed. Neither is good for the valuation, but maybe in 2 years down the line, it might be a different scenario.
I mean, there are bankers that specialize in reverse mergers, and it's a play that's very popular. Just I think 2 years ago, but right now I don't think it's because it's not that right now the investors are the reasons why all these biotech companies are trading below cash. The investors are skeptical that the cash burn. You basically they think that biotech company will just burn through all their cash. Capital market will still close, and the stock they won't be able to raise any meaningful capital without massive dilution. And why own these companies, right? So if you say, okay, the investors are worried about your cash burn. Now I'm going to in-license another asset, right, to increase my cash burn. The investors are not going to like that in this environment. Okay, it's a very different environment than a normal environment, where a reverse merger makes sense. In this environment, a reverse merger, I personally think, do not make sense.
Mm-hmm. Super, Jing. Thanks a lot for your time. I really appreciate it, and it was a very interesting discussion to know about your thought process related to the current scenario and so on. So thanks again, and hope to see you soon in Barcelona.
Great, it's my pleasure talking to you.